So the major indices sort of consolidating, a little bit of struggle for traction today. This, despite President Trump, his upbeat take on the economy. He just tweeted earlier, GDP growth during the 4 quarters of 2018 was the fastest since 2005. This administration is the first on record to have experienced economic growth that meets or exceeds its own forecast in each of its first 2 years in office. Growth is beating market expectations. That's on the back of both the S&P 500 and NASDAQ posting their best weekly gains last week. And now directional bias has certainly shifted back to the upside. But investors seem to be waiting now, perhaps to hear from the Fed later this week. Also, there's a potential delay between the meeting with President Trump and President Xi. Some are saying maybe pushed back to June. Here to weigh in on all of that, portfolio manager Erin Gibbs and Delancey Strategies chief market strategist Jared Levy. Erin, let me start with you. I kind of love this session today after last week, which was the best week. We're consolidating, but it's clear the bias is to the upside. And I think people are going to miss the next leg up.
This one is happening so fast, but I think another thing that we've really got to look at is where are the leaders coming from? And one of the interesting ones are the semis. They are just killing it. So I think that, again, sends really positive notes about we're going to get rid of these trade wars. The tech companies, these large tech companies, are going to do well, and even though we're obviously seeing declining earnings going into this year.
Jared, there's no doubt that Wall Street has to buy into the notion that there will be some resolution on trade. Call it cautious optimism, but the market could not be up this much this year if there was a lot of anxiety of no deal.
Yeah, I'm surprised, right? Because there really hasn't been any sort of details as to what's going to happen. I mean, let's not forget, last year was horrible for the U.S. China actually went in the wrong direction, 12%. So I think we were buying, what, $600 billion worth of their stuff. They were buying like $120 billion worth of ours. And again, that went in the wrong direction. So what I want to see if a trade deal's done, it's not necessarily about like, oh, we'll buy this or we'll buy that, but I want to see IP protection, again, to help our technology companies and telecommunications companies, as well as I want to see a difference in the way Americans and other foreign entities can invest and get a part of that Chinese market. That's what's important. Setting numbers and promising to buy X and Y, I don't think that'll do it. I want protection for IP, and I want to see our companies be able to do business better in China, in my opinion.
Meanwhile, the Fed, later on this week, I guess what people want to find out is when they stop with the quantitative tightening.
Yes. And that's going to be important. Markets have been really responding to the more dovish the Fed comes out, the better the markets are doing. So,
are you one of these people who's upset at the Fed, that the Fed is not doing the right thing, that it's bending to the will of Wall Street and markets? I mean, there are a lot of people I talk to, a lot of folks in the business who are upset about this.
No, see, I still see that when we look at the numbers, there's still a lot of mixed numbers. I still feel that it's very quantitative based. It's not just about sentiment. We're looking at slowing growth. And remember, we're now looking at contracting growth in the first quarter of this year. That's a big deal that we're coming down. So I think it's completely correct that ultimately the Fed should be concerned because we're seeing slower growth. And we're definitely seeing some questionable numbers come out early for January and February.
Jared, your thoughts on the Fed?
Yes, same here. I don't think it's one-sided. And in fact, if you sort of look back over the past decade, right, I mean, how do you sort of measure, you can't compare today's interest rate environment to like the 80s or the 70s like some people are doing. We've been in this low interest rate environment for very long periods of time.
Why
there are
wouldn't
still
you?
Pockets. Well, because it's just that the whole world is connected differently now than it was back then. And the whole world is able to buy money or borrow money very cheaply. So it's very difficult to be an outlier, a standout, and say, oh, let's get back to 10% when the rest of the world is at, 1, 2, 3, 4% top. So, again, you got to sort of stay within the context of this new global economy. And again, I agree that there are still pockets of questionable growth or contraction. And in fact, while corporate earnings are good, they're not great. I think we certainly peaked, fourth quarter last year or third quarter last year, and that is yet to be seen.
Right.
So I think the Fed is acting appropriately, and I think the homeowner, let's not forget, the housing market is really a big driver and supporter of the current economy. And without that, it's a problem.
Yeah, and that's probably, if you talk of fragility, that's probably the weakest point in our economy at this moment. Erin, Jared, thank you both very much.